We have a treat on Forward Guidance today. Emerging markets are extremely important, and I haven't covered them enough. I am so glad to welcome to Forward Guidance for a fireside chat Eric Fine, Head of Active Emerging Markets Debt at Van Eck and Portfolio of the Van Eck Emerging Markets Bond Fund, and Natalia Gurushina, Chief Emerging Markets Economist at Van Eck. Welcome to you both.
Thank you. Hi, Jack.
Thank you.
I want to start with your stories. How did you get involved in emerging markets? Eric, let's start with you.
I was born and raised outside the U.S., so that had an influence. I moved to the U.S. from Thailand, and my dad was actually a spy during World War II for the U.S., and my mother was a career diplomat, and so that's kind of how I grew up, and did my education in the States. And my first entry into EM was I worked for the U.S. government in Russia. Technically, I worked for Harvard. This was during an unusual period in the early 90s when the U.S. and Russia had incredibly aligned policies. There was huge common interest. And I built the first clearing system in the country. Russia and the U.S. had decided to do voucher privatization. We decided to do it very quickly, and 150 million vouchers were issued to everyone over 6 months old. You needed a clearing and settlement system for that. So 13 time zones, 33 cities. It did not seem cool or interesting at the time. It was definitely, none of my friends thought that was interesting, but it was the country's first clearing system, and it's the software onto which the SWIFT payment system was placed. So, it remains at least topical. And then I got into research, 14 years Morgan Stanley, covering Russia, Bulgaria, South Africa, Poland, the EMEA countries. Then I ran global research. Then I ran prop trading, and been at Van Eck for 15 years on the buy side. And really love it. Never wanted to do anything other than EM at Morgan Stanley. It was considered a cool thing to be offered to cover developed market economies, and that would happen. And I never understood why anyone would want to cover Germany or Japan when they could cover Brazil or Russia.
And why are emerging markets more interesting to you, Eric?
There's political risk. Number one, so there's so you actually have to think, and it can really positive, really negative. Number two, it's kind of the future. They're globalizing, they're cheap, their productivity rates are really high. Structural reforms are proceeding, so it's really an area for the future. And growing up, I grew up in Thailand. I'd wait for my school bus in the morning, and I'd see the Thai kids waiting for there was a very poor country in the 70s, waiting for their school bus in a nice pressed uniform. And I saw, I go back now and the country's a completely different place. Still has a lot of problems, and Thailand may be the least improved of some of the ones, but there's real progress, right? I go back to the countries I grew up in, or every 5 years or 10 years or every year, and they're invariably transformed. And so that's really exciting.
That's really interesting about SWIFT. May I ask you a question about that later? Natalia, what's your background? How did you get into economics? How did you become an economist? And then how did you specialize in emerging markets?
Well, I was actually born in the Soviet Union, which then became several emerging markets. And my kind of path to economics was via mathematics. So the economic faculty offered a very interesting combination of math, languages, and fun people to meet. So that was the starting point for me. Then I continued my education in Oxford, and when I came back, when I actually started, I was recruited by Bankers Trust to work in Moscow. I've got probably the best gift a young economist can get. I've got a major global crisis. That was the Asian crisis, 1997, 1998. And this kind of set my thinking. I know that I knew from the get-go that markets can go up and down very fast. So I think that's kind of formed how I look at developed markets. And frankly, my background growing up in the Soviet Union, when I talk about reforms, when I write about Argentina or when I write about India, and I say that reforms should be implemented fast because otherwise the pain will be extended, it's not just a something abstract to me. My family has gone through this. I have been through this. I know from my personal experience, the reforms work when they fast and furious. So that's my emerging markets background. That's my economics path. And why emerging markets? It's never a dull moment. And I agree with Eric. We live in the age of emerging markets. Emerging markets are the future. So that's why I'm here.
And just to echo that, a lot of what Natalia writes about in her research is the structural reforms happening in these countries. They do have practical, measurable impacts on ordinary lives, and they're often hard to measure. It's really hard to know what structural reform is. So, a lot of her publications are about that. So it's a real point.
But yeah, hopefully we'll talk about India at some point today, because I think that's a very interesting example of reforms working fast and actually bringing results very fast, both to the people and investors. So hopefully, yeah, don't forget to talk about India today.
Eric, I know, in the days when America had a trade surplus and America had basically a lot of money and a lot of gold. So I'm talking, well before all of us here were born and all the listeners were born. America was relied upon as to export capital to the rest of the world because it had a trade surplus. All of my adult life, and I think a lot of the adult life of people listening to this, America has had a deficit, and yet emerging market countries are still reliant upon foreign inflows and the dollar. So, your emerging market bond fund with Van Eck, it is not an equity fund, it is a bond fund. So I think a high percentage of what you're invested in are not corporate bonds. You do invest in corporate bonds, but a lot are sovereign bonds. So, Egypt, Zambia, India, they are reliant upon, your investors buying those bonds. So just how big is that world, and are they reliant upon inflows and basically other people's investors' money in the same way that the U.S. is, which has a massive fiscal deficit?
Great question. And what you're describing is most folks' image of EM. And it's partially why EM has done so well, is that the image of EM was set in the 80s and 90s, and it was of highly indebted economies with unsophisticated, shallow domestic financial systems and persistently high inflation and political risk. And that all stopped in the late 90s. Just going back to Natalia's point, we happen to share the same economic hero, Balcerowicz, the finance minister of Poland. We were both Polish economists back then, who did, serious shock therapy that paid dividends for 30 years, right? 30 years. And we saw that in the late 90s with the Asia crisis. You saw Indonesia, Thailand, Malaysia face 50% declines in dollar GDP. They had to let their currencies float, tolerate, and if inflation rose, they had to hike rates in a recession. And if an insolvent financial institution like Finance One in Thailand materialized, you let it go. If Daewoo's insolvent, you sell it to General Motors. You make incredibly hard decisions, and it worked. And for 20 plus the EMs are high savings rate or low deficit countries. Now, the fiscal deficit and the national accounts savings investment, makes things a little confusing in a journalistic sense because the U.S. has to run deficits. But the bottom line is that in the late 90s, almost all EMs reduced their value, reduced the amount of their debt, adjusted fiscal policy, inaugurated structural reforms, and most importantly, floated their exchange rates and inaugurated independent central banks whose only job was to target inflation. So that changed in the late 90s. And what happened in those last 30 years? EM bonds for the last 20 plus years, when you can get the data, have outperformed developed market bonds. So our fund, we invest in all EM bonds, so local currency government bonds, dollar-denominated government bonds, and dollar-denominated corporate bonds. Most of what we do is sovereign, local, and hard. But what the EMs did through having these very high savings rates was, and it either caused it or was the result of it. It's a lot of things. They created a domestic savings market, a domestic savings system, where most of their debt is now in their own currency. And so you do not have these episodes of self-reinforcing crises in which the currency weakens and your ability to repay dollar debt declines, so your currency weakens more. big number of our countries are net creditors in dollars. Even Brazil, which has a more questionable overall fiscal stance, is up to here in dollars. The specific implication or the kind of punchline of the story is for the last several years, the best inside EM, like the Asians in particular, who I described their experience in the late 90s, have interest rates the same as the US now for over 3 years running, right? EM Asian rates about the same as the US. And that's flight to quality behavior. So now you asked me about the size. It's the local market's a couple trillion. It depends on how you size it. Dollar-denominated sovereigns about $500 billion. Corporates, it's about over $1 trillion, but it depends on how you slice it. But these are massive markets. They've been around for decades. They were a big thing, in the 90s and aughts. And for the last 10 years, bonds have been such a bad story that no one wants to look inside that box called bonds. Inside it, EM has done well, and it's for the reasons that I referenced, and also the developments that Natalia has talked about.
But I think I wanted to add two things. So the importance of the floating exchange rate is this allowed emerging markets to accumulate reserves. And this what basically made them net sovereign creditors, which means that they have more reserves than external debt. And Brazil, to which Eric alluded, can repay its debt tomorrow with one phone call, external debt, if it wants to. So that's this is a very important link. Another thing is emerging markets, we often call emerging markets is not a monolith. There are countries, like you've mentioned, which have a lot of problems, Zambia, Nigeria, but there are also countries which we call Atlantic EM graduates. So this is the Czech Republic, the Thailands, countries like that. You go to Thailand, there is no external debt. It's impossible to sometimes source an external bond right now in countries like that. So there was this huge structural transformation, which was the result of the lessons learned from the past crisis. And I think that's the importance of this asset class. And this is one of the key reasons, what Eric mentioned, why EM bonds outperformed of the past, 2 decades, outperformed developed market bonds.
Yeah, I'm really glad Natalia mentioned that. The accumulation of reserves made them unquestionably superior credits in dollars. You couldn't ignore it. And the dollar-denominated spreads on these countries over the last 30 years have been even better performing than the calculation I gave you earlier, if you include local, where you can only get data for the last 20 or so years. But that was a huge positive. And what it meant is, or what it reflected is strong domestic markets. And if you keep them strong enough, long enough, legitimately, namely you maintain your credibility, you get things not just like the last 3 years, but like the last 5 days, with markets falling apart because of this so-called yen carry trade and Malaysian ringgit, where the central bank had been keeping rates arguably too high for too long, just waiting for the Fed. And if the see-through is Fed is going to cut, MYR is up 5% in 5 days. So it was a flight to quality asset. So that's the most interesting thing for me in the last few days is here I am, I'm so conditioned when markets are uncertain for EM to be just thrown into the garbage. And it really hasn't been happening for the last 20 years, and it hasn't happened yet again. EM exhibited really impressive characteristics in this, whatever you want to call this yen washout trade.
The free floating exchange rate is, people are sometimes upset about weakening EM currencies. I think for me, this is one of the most important shock absorbers in emerging markets, which allows us to stay invested in the asset class. Because when the currency weakens, central banks can hike interest rates. There is self-adjustment happening, especially on the external balance. Reserves are accumulating. And, even countries where we have issues with local debt, like Brazil, external debt outperformed this year by a wide margin. Why? Because, Brazil has got a lot of problems, but external is not one of them. So which is why, both Eric and I, we can keep going back to these reforms. We don't, it's not just an empty word. It's basically something that formed our asset class, let it develop, let it evolve, and allows us to stay invested in this asset class, regardless of what happens in global markets, regardless of global turbulence. I think that's the key lesson for me.
And so we're recording the morning of Wednesday, August 7th. It was Monday, August 5th, where the Japanese stock market was down 12% as the yen finally strengthened after its incredible depreciation over the past year and 2 years. And that was as the Bank of Japan had hiked. And needless to say, the Bank of Japan is a developed market, a DM. It is not an EM, emerging market. So, Eric, I gather that you think a lot of weakness is coming from developed markets, sovereign bond markets, not emerging markets, sovereign markets, which might be the perception of many investors who their playbook is 1997, where emerging markets really had an issue.
Yeah, I think it really is pretty remarkable. If I were if I were responsible for writing the global narrative, my title for the Japan episode would be "Another Developed Market Blows Up Financial Confidence." The global financial crisis was a run on the U.S. financial system derivatives, you could argue, right? And a lot of causes, but that was that. Then you had 2 Eurozone crises. And then now you have the country that first experimented with money policy, that is over indebted, that's coming towards the end of this, exit strat, or trying to exit, and arrived at hiking interest rates into a recession, into a slowdown, right? So that I think is the most important takeaway. And the other important takeaway is, who cared? The only things that cared in EM were BRL and MXN, where there was arguably some sort of carry trade. And in Mexico, there was kind of a heavy position anyway. But what was anchoring everything? Why no one really cared about JPY? CNY. China was an anchor of stability. The FX just sat there. That's why MYR could rally. That's why Thailand could rally. That's the only way this thing transmits. And now yen maybe could correlate with Korea, but Korea also had is in a different stage monetary policy wise. So yeah, I think this is yet another over indebted DM economy with great political sort of uncertainty, creating problems. And by the way, paying you nothing while it's happening. Right, that's the main reason. It's best prediction for a bond return is what your carry is, and the carry in EM is still so much higher than it is in DM, and that's our real point. We don't need to have an adverse scenario for DM because you're getting paid so much in real or in dollar comparison terms in EM.
Oh, but in all fairness, since you've got an economist in this podcast, there are more than channels than just kind of carry trade volatility through which currencies like the Japanese yen can affect emerging markets. Perhaps the carry trade unwind volatility being the most visible and loud, but it seems to me the competitiveness channel potentially is the most important and longer lasting, right? So you talked about the carry trade, and which created kind of another bout of volatility today. But the second way the Japanese yen can affect emerging markets is via portfolio rebalancing. So specifically, repatriations by Japanese investors if the yen strength continues, which it might, because the BOJ is still expected to out-tighten the Fed by about 200 basis points over the next 12 months. And there is an argument that this rebalancing will be felt more in developed markets rather than emerging, with which I agree. But if you look specifically at EM bonds, which is the topic of today's conversation, countries like China, Singapore, South Korea, Malaysia, Mexico were particularly popular with Japanese investors. So we might see some potential outflows there. And the third, perhaps, as I said, the most important for the real economy channel is competitiveness. So countries like Japan, China, South Korea, and also Europe have kind of a high degree of overlap in export products. And until recently, the yen's weakness created a lot of competitiveness issues for China, which had to balance its reliance on exports to prop up growth with the need to maintain currency stability and domestic financial markets stability. So if the Japanese yen strength has further to run, maybe not today, but like in the next 6 months, and importantly, it persists, this can actually reduce pressure on other central banks in the region to weaken the respective currencies for competitiveness purposes. So I think it gives them more policy space. So which is why, people like me look at what happens with the yen, not just from the point of view of day-to-day market volatility, but I think it can affect the real economy as well.
So the carry trade is folks, investors borrowing in yen at very low interest rates, previously negative interest rates, now very, very minor positive interest rates, 0.25%, and investing it in anything that yields higher, which is everything. European bonds that yield higher, American bonds yield higher, and emerging market currencies. So you said that the carry trade of favor in some instances is borrowing in yen and going into Mexico, MXN, the peso, borrowing in yen and going into the Brazilian real, BRL. And so that could explain some of the weakness. And Natalia, you're also saying that there
are additional channels, not
yes.
just carry trade. So just be mindful of a wider impact on both the kind of EM assets, especially EM bonds and certain currencies, but also the implications for China's growth model, for example, for China's policy space, because China is trying to experiment and slightly kind of change, not slightly, but to change its monetary policy framework. So I think what happens in Japan is actually much more important than just volatility trades or carry trades.
Yeah, and as the yen weakens, it becomes more attractive to the rest of the world and more attractive to buy Japanese goods. Like if you
exports are more competitive, correct? Yes,
exports are more competitive. Uniqlo, a
yeah.
fashion brand from Tokyo, I'm sure they produce it all around the world, but if they produce it just in Japan, they would be paying all their input costs in yen and selling it in dollars, which or other currencies which are much stronger, and that makes that competitive. And Natalia, a lot of folks are saying the reason that the stock market, the Nikkei, the Japanese stock market, sold off so aggressively on Monday was because as the yen gets stronger, it becomes less competitive for Japanese markets. So do you think that there's a dynamic where as the currency weakens, the stock market in local currency terms become stronger because it can outcompete the rest of the world?
Look, I mean, we've seen something similar in Turkey, but we are not investors in local currencies. We are US dollar-based investors, so we cannot ignore the exchange rate. We and Eric perhaps can elaborate on this a little bit more, but we do not really hedge our exposure because if you're thinking about hedging, maybe you need to rethink your exposure in that market, generally speaking. But I think that unfortunately the currency dimension is very important for us. We cannot just ignore it. But you are right. There are instances when stock market rallied in local currency, but which meant nothing for US dollar-based investors.
And maybe Jack, I'll just break it up a bit, which is yen stronger hurts the carry trade, right? So this and yen weaker helps reinforces it. Whatever economic impacts there are longer term, right? And so the market's very, very much focused on, is it up or is it down? Is it hurting the trade or not? And what are the asset prices that are showing themselves to be vulnerable? So that's one point to make. The other point to make is, and that's why I framed it as yet another DM crisis, is nothing is working. That's the real story. In general, rates are higher in Japan and the FX is weaker. It happens to have reversed recently, but that's no place to hide market, especially when equities, which were one of the places to hide, because that's also a carry trade, was part of it. So I think that's the bigger picture, that this kind of volatility coming from a DM is not a good sign. Right? And if you're a central bank and you're dealing with your interest rates higher and your currency weaker, you're in a box, you're in a corner. And what happened during all of this is that even when EM currencies, there was really only two, MXN and BRL, were weakening because of this unwind, their interest rates were rallying. It was purely technical. We had underweights in these, as it turns out, and we viewed it as buying opportunities. That maybe helped us have that attitude, was that maybe it should have sold off. And then the last point to make is Chinese inflation is lower than US inflation. And yet every Wall Street Journal article compares the nominal yields between these two countries as if it's some big challenge. Well, if you look at the real yields, the Chinese currency has been cheapening in real effective exchange rate terms for years now. So it's rock solid, getting cheaper. It's waiting for the Fed to cut, but doesn't need to. And who did the work to push the Fed to cut for them? Japan. That's the story. That's the story. Japan had the pain. Japan had to generate the sort of energy to get this see-through to rate cuts, and it helps every single EM in the world because they've all been sitting around pressured by these nominal rate comparisons with the U.S. and they're like, what can we do? Everyone's talking about this nominal rate differential. Okay, fine, we'll maintain real rates insanely for even longer period of time, like we have for decades. And now the coast is clear, arguably. I hope that was a kind of clear tie-up.
Can I actually bring you back to, because it's something that you said made me think about the second major developed market forced to walk back their policies. The UK about a year and a half ago, and now Japan, like literally within days of tightening of policy announcements. I thought I cannot possibly imagine, correct me if I'm wrong, this happening in EM. It's absolutely fascinating. So the speed,
Great point.
in terms of, global issues, we are talking about like literally milliseconds, have to, the Bank of Japan having this dovish policy remorse this morning, like days after an unexpected, surprising rate hike. This is a complete reversal. This is completely inexplicable. That's not a stable policy environment. And again,
it undermines credibility for sure.
It undermines credibility for sure, and it doesn't look like the UK was an exception some time ago. It's becoming a rule, really.
And look at what the Brazilian central bank did in its minutes earlier this week. Got hawkish. That's they have one focus: inflation. These, they have similar inflation rates to the U.S. and 10% market rates and double-digit policy rates.
But you know why the Central Bank of Brazil, Eric, could become hawkish? Because of those reforms. Because these banks, EM central banks, as a result of the structural reforms, are de facto independent. They do their job. They target inflation. And as a result, they can hike or be as hawkish as they want. Right? There was this very interesting discussion, and it's not just Brazil, that was very interesting discussion between the governor of, Bank of Thailand and the government about who's responsible for reforms. And it's not, the central bank's job to fix certain things. So I think that's what really makes emerging markets very different from the developed counterparts. Everybody knows, EM central banks know their job, they know they're independent, and they know they have to do it.
Brazil, they raised interest rates as inflation reared its head in 2022 to 13.75%, which is very, very high. Meanwhile, the Bank of Japan raises interest rates from 0.1% to 0.25%, and the entire global financial system loses its mind.
Yeah.
Can you say leverage? That's what that is. That's what that is. One central bank is incredibly levered, or one financial system is incredibly levered, if you want to look at that. That's why we always start with debt levels. Either total economy or central bank, right? There are different ways of measuring those. But I was glad, Natalia made that point on Japan credibility, and on Brazil, the politics are driving a lot of things right now. It's unusual for politics to be driving the U.S., right? Other than healthcare versus defense stocks sorts of thinking. But given concerns on inflation, I think it's worth noting that the EMs that went through their crises in LATAM, a lot of them in the 80s and 90s, Asia, the 90s, very different political configuration exists in these EM countries. It's very hard to get, regardless of where you are in our political spectrum, doesn't match the rest of the world's, of course, but it's hard to generate support for policies that say they're going to harness a central bank to achieve economic outcomes, because it's blown up, right? And it kills the poor. Inflation kills the poor, kills governments, kills financial systems, and they went through it. So a lot of these orthodox policies are popular. Not rah-rah popular, but yeah, I get it, we can't do that kind of popular.
And Eric, a lot of these orthodox policies are across the political spectrum, which I think Mexico is a very interesting example, because when President AMLO was elected, I remember going to meetings and everybody was telling me this is the end of the world. So we elected a populist, and Mexico was having, 2% deficit during the COVID. It was probably too frugal, too stringent. Now, bring the latest elections, and the whole conversation is all over again. So Mexico is losing its fiscal anchor. It's the end of the world. Claudia Sheinbaum is elected. Let's run. And what Claudia Sheinbaum is doing, literally within hours of being confirmed as president-elect, she reconfirms Minister of Finance, who is an Orthodox guy, who in turn sets up a conference call with investors, reassuring them about what? About the continuation of fiscal adjustment. Yes, there was some extra fiscal spending in the election years, should be expected. But this fiscal orthodoxy, this message was out like immediately. You didn't have to wait until the new budget will be out in the fall. That message was out within an hour. And this comes from the party which is not usually associated with a lack of populism. So, this is, even in Brazil, Lula has to negotiate on certain issues. He cannot just have whatever he wants in the fiscal sphere. So, these markets learned and governments learned the lessons. And frankly, it's the markets and the population and the rating agencies which help to discipline them, which unfortunately doesn't happen in the case of developed markets too often.
When it comes to performance of emerging market bond funds, you can either invest in local currency, so non-dollar denominated bonds, so the Malaysian ringgit, or you can buy the Malaysian sovereign bond in dollars, and that is what's called a hard currency. So when often it is true that emerging market currencies have underperformed the dollar, and ultimate examples as the Turkish lira, but that is really only half the picture because those currencies yield far more. So, for example, one thing that I really don't like is when people say, in 1910, the value of a dollar was X. So therefore, if you had a dollar in 1910, it's now worth the purchasing power 1 penny. And that's true if you just kept it in a vault. But if you yielded it in cash and you got, 4% when the interest rates were 4%, and then in 1980 you got 17% or 19%, you actually kept up with it. And in the case of emerging markets, the idea is that the additional carry, the Brazilian currency will yield more than the dollar. Yes, the Brazilian real.
I don't think that's really the story. I think the story is that if your currency is weakening, but something else happens to support external debt, sovereign bonds, hard currency debt, like you mentioned Turkey. So when the Turkish lira was selling off and local bonds were underperforming big time for the first half after the elections, after the latest presidential elections, hard currency, sovereign bonds staged a massive rally. Why? Because floating currency means less wastage of international reserves. And this what, we did this trade. I mean, we really enjoyed being in Turkish hard currency bonds at that moment in time. So that's exactly that's the key message. Floating currencies and structural reforms allow you to stay invested in the asset class. Even if the currency goes to hell, you can still make a lot of money in many instances in sovereign bonds. And frankly, weaker currencies in certain cases can support local corporate bonds, local corporates, because especially if they have some export revenue. So Eric, maybe you can elaborate a little bit more on that. But I think that's really, this story has got three components to me. It's not just about carry and underperforming or weak EM currencies. It's the fact that the currency underperformance paves the way for often outperformance of corporate hard currency bonds and sovereign hard currency bonds.
And we say hard currency bonds, you mean the dollar. So if
dollar-denominated or euro-denominated,
Turkish
correct?
Yeah, has been weak, and it has been quite weak. The dollar-denominated bonds do well because the currency weakness is a shock absorber.
It's a shock absorber, exactly, and it leads to automatic adjustments of external balances. It reduces imports. It boosts exports. And if the central bank is not trying to artificially intervene and support the currency, it also means high international reserves, which again is supportive of hard currency or US dollar-denominated debt.
Right. Thank you for that, Natalia. What I was just saying is I wanted to explain to people the Brazilian real has depreciated against the dollar. Why would I ever invest in a Brazilian bond? Because you yield more. That's what, I'm saying.
I would say the following. First, just very narrowly, when you see pressure on a local currency, you know what you often see from locals? They buy their dollar-denominated bonds. They don't exit, right? So that's one point, is that you can stay in EM, they're winners. But I think the main point on the local versus hard issue is EM is not a monolith, and it depends. Depends very much on the country and where it is and what's cheap and what's not. So that's one point. And the other point, to put it together for your listeners, if you've got a low amount of debt, it's a good thing because you have less dependence on financial markets. You often are paying as much as you're borrowing, right? Or often, for example, Thailand is often paying more in principal and interest than it's borrowing from the market. So you create these great technicals from a low debt level and good fiscal policy. But the most important thing you get from that is your central bank can have independent monetary policy. It can easily focus only on inflation, and it can always maintain high real rates, which they've done. And so the low debt allows the central banks to pay you more. It doesn't mean that they're always doing it, and it doesn't mean that it's enough, but that central bank rate is the anchor for their yield curve, and it's often ends up with market rates double or triple what you see in the US, and it means that the currency has to sell off if you're going to lose money, because all things equal, you get your carry. You should expect some currency weakness if the yield is high. That's what it's there to compensate for, and I think that was your point, Jack, is that the FX can weaken, but you can still make money. And what was so fascinating with this, the Japan, carry crisis, was what I'd mentioned earlier, which was it was only the FXs that were weakening. The bond prices were going up, M-Bono prices were going up, their yields were going down. So this was not an exit. This was a very technical thing having to do with FX, probably a lot of forwards and derivatives, but not an M-Bono holder, right? Those rates went down. Why? Because the see-through from the episode was lower rates. And if this was a confidence crisis in some of these countries, their rates would have pushed higher, and they didn't.
So the duration component, emerging market bonds actually rallied in local currency terms because they said, whoa, the Bank of Japan, the last central bank to have negative rates, they actually don't have any teeth whatsoever. So emerging market central banks can cut interest rates, for example, the Brazilian central bank. And so they rallied as interest rates fell.
Because everyone anticipated that the odds of the Fed cutting were much, much higher. The confidence of the forecasts, the confidence of expectations right now are very, very different than what they were a week ago. You had the CPI report, July 11th, I think it was. Then you had last week's employment report, and that paved the way. And then you had this, this crisis, and the see-through was, okay, not only have we had economic weakness and the door opened from inflation, the door to cuts open from inflation, but oh my gosh, Japan, a major, a very important country for the US, needs rate cuts from the Fed. And so if that's the strong opinion, why should, Mexican rates are highly correlated with US rates, and they rallied. Whereas if this was an exit, oh my gosh, this is a recession or this is a crisis, then you would just exit M-Bonos, and that did not happen. So we're pretty strongly minded. And like I said, also, we didn't own it. We thought the big problem with Mexico was that it was just too heavy, and we didn't own it into the election, and then it, cheapened out. And we see the problem in Mexico was never the heterodoxy. That was never our concern. The problem in Mexico was too many people owned it, and JPY knocked it out and made it cheap and attractive, and that's all we wanted.
And when you say too many people own it, how much of those investors are unlevered funds such as yourself versus leveraged hedge funds versus banks?
Yeah, hedge funds aren't that big in this space, and the big hedge fund trade on the themes that we talk about of some countries in good shape and some countries in bad shape fiscally, in the big picture sense, debt and fiscal and monetary policy, the big issues, had expressed it mostly intra G10. So with emphasis on the funding side, right? In other words, it was such a negative view on Japan that what you were positive on was not the most important thing. You're making money because the relative rates were higher, right? You're paying this on your funding, and you're receiving this, and the currency's weakening. So you're making money every day, and you don't need, let's say, British pound or gilts to be rallying. So that was the bulk of I think where bulk of the action was. It is hard to gauge. So what we do is we look at the screen and we look at how is the market reacting. And it seemed very short-lived and not a big issue. I think the issue with the Mbono trade was similar to why EM bonds have been ignored for the last 10 years, which is a lot of investors get the EM idea, right? They've got low debt, they pay you more for it, it's done better than DM for 20 years. What's the problem? And they'll mention problems. And so and one of the problems is they have to go to some committee that says, well, isn't EM a disaster always? And, isn't it always generating these crises? And so that's sort of a little bit of a headache. People don't want to have to do that. And so there was a big desire to put the trade on, but not doing it conventionally. And I think it was arguably somewhat lazy trade from crossover. And a lot of big institutions just, I get EM. I'm going to express it all in Mex peso, all in M bonos. And that's the complete opposite of our philosophy. We think you're supposed to be incredibly diversified. There's alpha all over EM. You don't need to be that concentrated. But it was much more an EM long-only phenomena. And I think that's why the market reacted that way. They didn't change their mind on Mexico. It was just an FX. FX moved all over the place. The rates rallied. People didn't sell bonds. So I don't think the hedge funds have been really a big deal in our space. If any, it's MXN, BRL, that kind of stuff. But they're not a really big presence. The Brazilian hedge funds can also be sometimes move things a lot, but they've had a lot of sort of burned fingers. So I don't think they're doing much.
And you own a lot of different countries, including Zambia, Chile. Tell us about the role of diversification. And if an investor would ask you, why Zambia? Okay, Eric, we understand you want to invest in some countries where they have a risk, but Zambia, that's a little out on the risk curve. I mean, what are they paying? 40%? I mean, explain that.
Yeah. So first, on your point on diversification. Our funds are incredibly diversified. I love looking at our pie chart, and investors, I think, like it because they see the carry of 7 and the yield to worst of 8.5 or whatever it is, and then they see the pie chart and they see things all over the place. So diversification is important, and I'd mentioned before that it's not a monolith. That there are asset prices that behave as risk off, safe haven type asset prices, some that have beta. So diversification is really important, and I'd say the most important thing you get in EM is you diversify out of DM. You diversify out of DM, right? In other words, it's great that you have diversification inside EM, just in principle, but it's the big concentrations are in DM bond markets. That's where everyone just sits and is relaxed. The framing quote for our fiscal dominance piece was the Mark Twain quote: "It ain't what you don't know that's going to get you." Brazil is not going to blow up the world, right? It's what you know for sure that ain't so. Right, that's what's going to get you now. And so with that, let's turn to Zambia, around 30% rates, and entering an IMF program, right? And they just settled with external bondholders, and they floated the exchange rate somewhat, and are paying really high real rates, and sideways pays us a lot. Now, we got sideways on rates and the FX rallied the last couple quarters. But the most important point I'd make is these are small positions. You mentioned Zambia, it's neat, it's cool, but I guess the point would be that, when something's yielding 30%, you really kind of have to have a lot of damage. You have to predict a lot of damage. And now, of course, it was cheap on our process. And in our second step of our process, we said IMF deal, debt deal, all good stuff, positive. So we didn't see any of these non-systematic reasons to cancel it. But we will be nimble on those things. That's the other key thing is, one of our lines is we do not do Friday meetings, right? We don't think all week and then say, well, what are the trades we'll do, and we'll do them on Monday. We're up, at night, and we'll do things quickly. We have exit levels for everything. Most of the time, we're not doing stuff, but on these smaller names, they can be volatile. But yeah, there are if you invest in all EM bonds, you're basically seeking in a much bigger alpha space. There's alpha there, but we have a very small exposure. It's not a big slice of the portfolio. We are constrained. We can only deviate from the benchmark so much anyway. So yeah, we like Zambia. We do like Zambia, and Sub-Saharan Africa has a lot of really. This is Natalia's exciting areas. I mean, some of these countries are really doing. At the bottom is people are voting for the person who's going to keep the electricity running, not based on other more. It used to be much more along either tribal or religious lines, but there's a real sort of growing urban class that that's very cosmopolitan. We see that in Nigeria with Peter Obi, but you see that in a lot of these countries. There have been a lot of changed governments that have gone through really anti-corruption processes, and you could put Zambia, maybe Angola in those categories.
And it's not just anti-corruption, it's also kind of the use of modern technologies like digitization. I mean, this stuff really helps in terms of revenue collection, and very low tax collection is really this country's Achilles heel. We're talking about like 7% of GDP revenue collection, 10% of GDP. So, when you hear that 50, 60, 70% of revenue goes on to interest to service the debt, I mean, this is the reason why, because revenue collection is non-existent. I mean, so for these guys to pay attention to what happens in countries like India, which made absolutely massive improvements by using digitization, by making it widespread, I think technology really helps. And I think that's what perhaps, I think a lot of investors maybe underestimate this. You go to the IMF, and digitization is a key word in pretty much each and every developing country meeting. That's a big deal. That's really is a big deal.
I don't want to give the impression that it's all Zambia fund. The percentage in the Zambian currency, Zambian kwacha, is 2.2%, and by comparison, you've got 5.7% in the South African rand and 7.4% in South African bonds, hard and local currency, and that is as of June 30th. So it might be slightly different now. Eric, also, I point out maybe there are advantages, and if you ever have alpha, if you ever have a reason why an investment outperforms, there ought to be a reason, and some times the reason is it's misunderstood. And so I'll give you an example: is if an oil company went bankrupt in 2016 and they emerged from bankruptcy, and people say, oh, it's bankrupt, they're bad, then it will be cheaper, and you could buy by taking advantage of the fact that people don't understand the currency change. Maybe what it is Zambia. It sounds a little bit like Zimbabwe, which is the most inflationary currency ever, and you can harvest that premium of people not understanding that it's a different country. Or
I think you are totally right. Crazily, you are completely right. It's funny when I speak to U.S. investor audiences, even institutional. Sometimes you don't mention country names in the U.S. You mention any country name in the U.S. and people freak out. I think it's misplaced, but Europe is much different. Asia is a lot different in terms of receiving that. But yeah, you mention a country name, they'll think political instability, backward financial system, poor structure, bad debt, everything. And I don't think that's correct, and it's creating an incredible opportunity. Brazil has at 4% inflation, probably moving to 3 handle. That's not that bad, and look at what they're paying you. I was also going to mention that since we were talking about Sub-Saharan Africa, but also just how EM has changed, is the role of China, not just CNY being stable and their policy generally being respected, but China's acted fairly constructively in Sub-Saharan Africa in the last year, right? It's a lot less of an obstacle in this so-called new architecture, right, where China's a big bilateral lender, and it was kind of viewed as not being quick enough in agreeing along with IMF and Paris Club restructurings, but that's gone away. All right, there are now models. They're now cooperating with that, and it's an alternative source of lending for these countries. So it's a real positive, right? They don't just have to go to the U.S. or the international financial institutions. China's there as well, and not in a way that's encouraging these countries to exit reform programs. In other words, they don't want to lend into a default situation just as much as the IMF doesn't. So it's arguably purely just an additional source of financing to a lot of these countries.
But talking about Sub-Saharan Africa, I think one of the perhaps most misunderstood stories of the past year was South Africa's fiscal adjustment in the run-up to the elections, which was completely unheard of. And frankly, this is the fiscal sleeper story of the year. Absolutely incredible. So, it's not just small countries with strange names that perhaps some investors, misunderstand or mishear or misread. It's big countries like South Africa in the region, which do incredible things, run incredible adjustments, and it's pretty much ignored by the press until some people started to scream about it on every corner. So yes, it's not just Zambia. It's I think South Africa was a great fiscal example, by the way, this year. A really, truly unusual story when the fiscal performance improved in the election year. That's on the spending side, which was absolutely incredible.
And what was that change, Natalia? And I should say, per June 30th, for the public disclosure for Eric's fund, that South Africa was, as I mentioned earlier, the largest weighting in his fund, 7.4%, including South African rand and dollar bond.
So what changed is, the royal elections where surprisingly, the African National Congress didn't perform as well, and South Africa ended up having the first ever government of national unity, which is kind of a strange animal. Nobody knew exactly how it's going to work, but it looks like it's a big government, but it's for all intents and purposes, it's a centrist government with good appointments in key ministries. So the expectation is that it's got a fairly strong reform mandate. There was an uncertainty for about a month, I would say, after the elections, which was unfortunately amplified by some, without naming names, unfortunate reporting in the press, which was, I think, very negative. But I think it's a great story which has got further to run in the next several years if this government implements reforms, continues fiscal adjustment, continues reforming state-owned enterprises. It's a pro-growth setup and it's a pro-fiscal adjustment setup which benefits local bonds first and foremost.
And Natalia, I can tell you've been wanting to talk about India. Tell us about what's been going on in India. And I should say the stock market in India has been on fire, but I noticed that I'm not seeing a ton of Indian exposure in Eric's fund. And so then Eric can explain why, perhaps.
The importance of India is that it basically shows that structural reforms can bring results in a short period of time, in 3 to 5 years rather than 3 decades, and both the population and investors can benefit from these reforms. And 3 areas where India's structural progress was especially impressive are, first of all, taxes, second, digitization, about which I was already talking, and formalization of the economy. And these reforms help to unleash this massive growth potential. And as a result, India is one of the best EM growth stories right now. And it could be a defensive play amidst the US recession fears, uncertainty about another round of trade war with China, rising geopolitical tensions, especially in the Middle East. And looking forward, if current trends continue in 12, 15 years, India's economy will be of the same size as the Eurozone, becoming effectively another independent global growth driver. And from the fixed income perspective, and that's what limited our exposure there before. India was not part of the EM local bond index. So this inclusion happened about slightly more than a month ago, and with a very small initial weight, but ultimately India's weight will grow to 10%. So this is kind of the event of the year, which we watch very closely. And this inclusion resulted in huge capital inflows, which also hopefully will further structural reforms, especially fiscal adjustment, because that's what fixed income investors are watching. And India's debt to GDP ratio, unfortunately, kind of highish by emerging market standards. And the first signals are very encouraging. The 2025 budget showed that Modi's government is not turning populist despite worse than expected performance in the latest elections. And also, I hope that India's local bond inclusion will help to boost bank lending and improve capital allocation, because with a new buyer out there for government bonds, Indian banks can hold fewer government securities and explore other investment and lending opportunities. Investments is not India's strongest point right now. So if we indeed see more progress in this area, it could be very growth positive. And with that, I'll pass to Eric to talk about our exposure in India.
Yeah, India is a bit unusual. And if you asked me, if you were talking to me, let's say in the late 90s, I might, I might have had a different attitude. But in the late 90s, a couple of countries, Malaysia, India, you could argue China, has arrived at this, well, that's what I'm going to argue, Indonesia to an extent, of a stable FX policy. Essentially, you could call it investment-led, but an investment-led policy, but essentially keep the FX stable to create a stable investing and inflation environment, right? That's the idea. Now, if they can intervene, that's sustainable. If they can keep inflation under control, that's actually sustainable. And if they can keep fiscal and financial under control, that's actually sustainable. Now, the reason I would, in the late 90s wouldn't have said this is Malaysia tried this, and all the cool kids said that was wrong. And, I was still younger and wanted to be a cool kid. But a lot of those, there doesn't have to be one. We're more comfortable naturally with an inflation targeting regime and a floating FX. India doesn't have it. China doesn't have it either, and sometimes it works, but it doesn't work to generate really high carry and good bond returns. To the extent that it works, it can create a great economy and great equity returns, right? The story in China has been equities, not bonds, certainly not their local bonds. We've done interesting things there, so in corporate bonds. And so that's the answer on the biggest chunk of India and our benchmark, their local government bonds, is that's not how India is being managed. It's not being managed for the good of that market. It's not a bad market, but it's just not cheap enough for us, and it maybe stays that way, which is fine. What we're doing there is we have corporate bonds in dollars, and they're generally project bonds, right, where the proceeds from most of these are energy generation, go directly to are owned by the bondholders. They're not at a holding company level. So we own operating company level bonds, and they're cheap because, and we do a standard analysis there, right? We just compare the fundamentals of these corporates to all the corporates in our database, and they're paying us way too much. And we see nothing in India on our second step of our process for non-systematic risk. All this stuff is good. And I'd remind, only because we're talking about India, but remember what the story was at the beginning of the year. Oh my gosh, there are all these elections and these crazy, insane, dysfunctional EMs. What a disaster it's going to be. And what did we get? India, continuity, basically. Mexico, continuity. South Africa, the most reformist government arguably in a long time, with an alliance with the DA. And what have we seen in the developed markets? Right, political risk has to be pronounced in the U.S. and parts of in parts of Europe. So I wanted to mention that, especially in the spirit of your earlier question, Jack, about the sort of image that EM has. And even after South Africa had this, alliance with the DA, the headline was ANC gets below 50% for first, which was never the market's expectation.
African National Congress?
Yeah, the ANC, yeah. The headline was they got below 50% for first time. That was the headline that we saw. And, we were getting ready for this thing for weeks, and we were, everyone was looking between 39 or 41 for these guys. But because this is kind of an asset class where there's just not a lot of people looking at it, it was, I haven't looked at South Africa in years. Oh, what happened? Oh, the ANC was below this. Well, no one, that was always going to happen. And what was not focused on was the likelihood of an alliance with the reformist, or it was definitely market-friendly DA, which is, what materialized.
But also the tone of the reporting is kind of, it's almost anecdotal, but I was like literally running to Eric in the morning while all these things were developing. But Eric, somebody's gaslighting me, because the stuff I'm reading in the press is not what I'm seeing. It's like literally 180 degrees. I mean, the coverage was kind of very unusual.
That's why EM can be great. That's why, that's to Jack's point, Natalia.
Exactly.
Yeah.
That was great for us, but I was just, it was the recollection of those morning complaints for a couple of weeks. Yes, that was
I told
fun.
Natalia I'm glad they're misreporting it. Right? There was I don't know how that's my problem, right? That's as long as you know what you're supposed to do and what's actually happening.
And so it's an important point that countries' policies can be good for the equity market, but less good for the bond market. So you say, yeah, Indians, I'm just looking at the Bank of India's policy rate is 6.5%. That's not good enough on the sovereign level to really get you that excited, Eric. Now let's turn to China, where their interest rates are even lower. What are your investments in China, and how do you position there, and why?
Yeah, China's been very interesting. We're not interested in onshore bonds and CGBs. They're not attractive on our process, even given the statements I made about their real rates being higher and being the more correct way to look at it. But they're not attractive on our process. And given heightened political and geopolitical risks, these are custodied onshore, right? Onshore meaning not our shores, not Western shores. And so you can't ignore that risk. And if I'd want to get paid a lot for it, and I don't think you can get paid a lot for it. So if we ever were attracted, we'd do it through an offshore vehicle like Asian Investment Bank that issues bonds in CNY with a similar yield to the government curve, but they're offshore. But in general, not cheap, and it's got that layer of risk. Now, China, we had been for years minding our own business, not really investing much in Chinese corporate bonds because they just weren't that attractive. They blew up. All right, the corporate bond market blew up. So IG bonds were, trading at cents on the dollar. And so for the past now 2 years, we've found really attractive opportunities there, very idiosyncratic. And there were kind of three categories. One was multinationals with offshore assets that we're not too worried about, like a Fosun or something like that. Another category was actually owned by the government, let's say Ministry of Finance owned Huarong, right? And some of these bonds, just because everyone was selling, went to 60 cents on the dollar, right? For something maturing in a couple of years and the entity's owned by the Ministry of Finance. Now, whatever China's problems are, dollars is not their problem. They have all, their dollar-denominated government debt is tiny. And then there was this other category of the truly risky stuff that you'll read about and maybe in the Wall Street Journal. And those were trading at low prices. And so we got attracted to those. But because, corporates can be illiquid and because China headlines can, hit something that maybe it shouldn't hit just because of liquidity, we've always had a shorter flashlight on it. So we didn't think we'd own these through the rest of the year. We have reduced some of them that hit targets because we are worried about geopolitics. It's not a headline over the weekend from a legislator in the U.S. Can affect an illiquid bond if it's dramatic enough. And it seems as if we're in a world where you're supposed to be wary of that. So we have we have our finger on the trigger there generally, and we've reduced recently and might do more. The great thing about China is everybody hated it as well. And we didn't talk about investability, but that's a big question that comes up a lot. Like, is it even, big institutions are saying, well, should we just X China from benchmarks? And that's a real thing. I think that's a reasonable thing
Eric,
to worry about. But we got paid a lot for it this year. Yeah.
It's the economy which is in the middle of a major structural transformation. So you cannot, when such a big structural shift happens, when there is a big change, attempted change in China's growth model, it's difficult to have, long-term secular kind of exposure to China. But it's not impossible to ride these policy waves because, they are attempting certain things. But I think there is certain kind of misunderstanding when you ask a question about instability. It seems to me that the market still somehow expects this, a wall of liquidity to appear in China, kind of something similar that was so popular in the West during the past crisis. And it's not going to work in China. It's not going to happen because, many policies the Chinese try to implement is basically their longer term structural issues. And as I said, staying invested in a country which is in the middle of a structural transformation, China knows that it's got a problem, but it will take a lot of time to fix it. And China is not looking for fast fixes, like, for example, the housing sector. It might take a little bit, I would say, maybe too long to find some, developing a blueprint for defaulted real estate companies. But nevertheless, China's problems are, it's not liquidity. There are very deep structural problems which will take time to resolve. So, and don't expect a wall of liquidity, which is why I think that's what I think at the core of this question about investability in China. A few years from now, if China is successful in developing its social safety net, resolving some of the housing issues, maybe using central government's balance sheet, because the central government's debt, as Eric pointed out, is still very low in China. That could be a different story, but that's a long-term drive. This is a long-term drive in China, but you can still write like policy waves to make money.
And then Natalia, so you say don't expect a wave of liquidity and
A wall of liquidity, yes.
wall of liquidity. What is the structural change in the Chinese economy that is coming from the top? And what was the old Chinese growth model? What is the new Chinese growth model? And how far along is China? Are they 20% of the way there, or 55% of the way there, or closer? What do you say?
Yeah, so the old growth model was based on several things. First of all, exports, real estate, and a lot of lending. So if you look at China's overall indebtedness, it's probably closer to Japan than to Poland, I would say. So, the issue of leverage in China is a big concern. And there was some bubbles.
Total economy.
Total
Yep.
economy. It's not the central government, total economy. And there were, the real estate bubble. So China knows that it has these problems and it's trying to resolve them, which is, unfortunately happening in countries like Germany. You wake up an average person and ask them something about Germany's growth model, they probably wouldn't have a clue. But, China's growth model on full display. And what is happening is effectively addressing the excessive leverage issue and also trying to kind of deal with the real estate bubble without collapsing the sector. So there are some interesting ideas there, like, for example, social housing, buying some of the housing stocks from private developers by the government agents and developing them into affordable houses, which I think is great in terms of something like similar to maybe Singapore model that was mentioned as well. So these are great ideas, but you cannot resolve these issues in 1 year or maybe even in 3 years or 5 years. It's a long-term process, right? And these are structural process, which there is an interesting example. So some of the vehicles, financing vehicles that was set by the government, especially in real estate in China, they are not fully used. Like some of these facilities are, the average outtake is about 20%. Why? Because there is no demand. Why there is no demand? Because the issues are structural. So you can throw as much money as you want at these issues and the result will be the same. Another problem is because the old model was so kind of glued, so linked with leverage with real estate. Chinese consumer is the only thing Chinese consumer wants to do right now is save. There is a very interesting survey done by the People's Bank of China, which shows the consumers' willingness to save, to consume, to invest in real estate, in new houses, and to invest in the stock market. And the only line that goes up is willingness to save. So giving more helicopter money in this situation, what is going to resolve? This money probably will not going to be spent on consumption, but will go to savings. So I think the general direction is absolutely right. But again, China is trying to do certain things. There were some interesting statements from the central bank advisors, senior advisors, maybe doing something about implementing inflation targeting. So, there are interesting ideas, but I think China is still in the searching stage, which is why I'm saying, I don't know whether it's 15% or 20%, it's difficult to quantify, but the model is becoming different. It's becoming more inward looking as regards the type of the growth model. And frankly, we cannot always expect China to save the world's growth. But, the rest of the world, especially emerging markets, can still benefit from China's evolving growth model because, most likely it will remain commodity intensive.
Yeah, I would just say two things to add or sort of reinforce that, Jack. First is China, like a lot of our countries, don't have policymakers that wake up in the morning and think about how to get the stock market up, right? And look at what Japan and the U.S. did. Right, U.S. stocks down 5%, and the Fed's predicted, is priced at doing an emergency cut. What kind of policymaking environment is that? That your entire policymaking apparatus gets activated by declines in equities? That's not very serious, right? And so it's a good thing that China's not doing this big bang, this big rescue like they did after the GFC for the planet, right? For planet Earth. So that's one thing. And the second thing I'd say is, in terms of the EMs, the transmission mechanism is CNY, and it's been stable and getting cheaper, right? So it's protecting consumption baskets for Chinese and is still attractive. So, it's a good thing when a country has low inflation, an ongoing structural reform agenda.
And another thing is, I would really encourage our listeners not to think about China as a single entity, as a monolith. There are different Chinas. There is the old economy versus the new economy, which, by the way, is doing quite well.
Yes.
The rural China versus urban China, coastal areas versus hinterland, north versus south, different policies agendas, different policy priorities. So it's a complicated story because China is a complicated economy.
So that model, the old model of very export-driven, manufacturing-driven, but not very high in the value chain, and then accumulating a large amount of U.S. Treasuries and foreign exchange reserves, and then having the banking system be quite levered and lending to infrastructure and real estate, and have the real estate developers be levered. In America, the subprime mortgage bubble that led to the Great Financial Crisis, that was home buyers being levered. In this case, the Chinese household is not quite levered, and actually they have a very high percentage of savings of their income. The leverage was in the developers of real estate, and that bubble, if we can call it, began to implode in 2021. And I'm just looking at a collection of property bonds, and that really collapsed in value, down to 30 cents on the dollar by
which is great, which is awesome.
2022.
Yeah, that's the market operating for you. Yeah, why not? What's wrong with that?
Why should a government prevent prices from being discovered? This is a great thing when a government doesn't step in and protect the whole sector. It may not be good if you owned the bonds, but that's, we didn't, and we looked at it as a try. But sorry to interrupt, but I wanted to make that point, is that these governments don't wake up every morning and try to gin up markets, right? That is just not how they view their jobs.
Yes, and I think people can think America capitalist, China communist, and in some ways that frame of reference makes sense, but it is not the case that the Chinese government likes to print a lot of money and give it to citizens and bail out citizens or even corporations. If they do that, they do it through the banking channel rather than through the government channel, where in America, we have become quite fond of that over the past 20 years.
Well, but you know what? Let me tell you one thing. I think there is an understanding. If you look at the share of consumption in the U.S. GDP, it is much higher than in China. So if you think about kind of vehicles to stimulate growth, the emphasis maybe on consumption in the U.S. makes sense, as well as the emphasis on manufacturing and infrastructure in China makes sense, because the share of these two in GDP is much higher. So it's kind of, in a sense, if you try to look at the vehicles, how to provide a kind of near-term fix to growth, that's a very natural response to me. But what I see right now is that in a situation where a lot of reasons behind, why the Chinese consumers step back and not participating, kind of not consuming as actively as before, these are structural issues. So you throw the money, what will be the result? What will be the improvement? The money will go to savings. I would, pretty much sure 100% of this money will go into savings.
Oh yeah, but one thing's for sure is, look, China owns the banks and it owns the SOEs, and so a crisis, is not an obvious thing. And so these structural changes that Natalia is talking about will, have an arguable context of extreme stability, as we've seen in CNY. And also, by owning assets, that does put a government in position to give them to populations, right? In a formal form, as essentially assets for social welfare programs, kind of a retirement, healthcare, however you want to think about it. But that's something that could materialize there as well. But I think the main point is whatever they're doing, it's not crisis generating. In fact, it's stability generating, and that's what we really care about. And the rest of China is individual trades that either make sense or don't. But crisis isn't what they're generating. And part of the reason why is they're not trying to gin up markets every morning. They're willing to let prices settle where they need to settle.
And Natalia, earlier you said that financing vehicles, I believe you referenced to local government financing vehicles, LGFVs, in some instances hadn't used all of the money that they do. Explain that, because from my skimming the articles about China compared to your detailed analysis, and a lot of things that aren't even in the entire articles, local government financing vehicles in some instances are having trouble because there's not enough money. So can you just explain
No.
that?
What I was referring to is support programs. There were certain support facilities set up by authorities, basically to provide support to struggling economic agents, including to some in real estate. And what I found very surprising is that on average, if you look at all these support programs out there, I think, if I'm not mistaken, a few months ago, they were used, I think only 80% of this money were used because there is no demand. And the percentage, the actual usage of these support funds in real estate was close to 20%. So, which basically tells me it's not necessarily the issue of money. It's the issue of making regulation changes, structural transitions. Maybe, a huge issue in real estate is unfinished houses. So I've mentioned houses that were finished but unsold. Unfinished houses is a huge issue. People paid money, but they are yet to get their houses. Do you expect these people to consume? No way. Absolutely zero chance. These people are not going to consume unless and until this problem gets resolved. But, when you look at the actual support programs out there, the fact that they are not fully used is an indication that it's an issue is on the demand side. It's not the supply. It's not the supply side issue. It's a demand side issue in this particular case, which has got to be resolved structurally, not by using another, helicopter money or wall of liquidity, however you call it.
Yeah, it might not. The model is not going to be the sort of Western model where just tons of things get thrown, and you worry about the consequences later. They're just not. Most of our countries don't make policy that way. They can't. They risk. They don't just risk losing, right? They risk a lot more than losing their political power, right? One thing we didn't talk about in China, but I'll only mention this to you, Jack, in case you have a follow-up on it. But one thing that's changed is the Treasury accumulation policy you mentioned seems to have changed.
Please mention that. That's of extreme interest to our viewers, please. Yeah.
They've obviously had a gold accumulation strategy. We've looked at, central banks for decades. And one of the strongest opinions I have is I believe a lot of the data. It's often secret, and big important countries, Russia was a country I grew up with, there are almost always deals with local miners, and Russia and China have huge mining industries where you buy at a price that you don't know or that's agreed to sell directly to the central bank, and you don't want to report a lot of this stuff, right? These sovereign wealth funds in advanced countries don't like reporting their holdings either, so I get that, but gold has definitely increased in most EM central bank balance sheets, not so much DM, so that's interesting. And if you put yourself in the seat of a central bank, what do you want in your bonds? You want high real rates set by an independent central bank in a reasonable fiscal and maybe financial context. And you certainly don't want to think that they could be seized. Right, so you kind of won them over at the higher real rates and good fiscal policy, but when you add sanctions risk, that becomes existential, right? Brazilian authorities can't spend a moment worrying that if they change policy, that their national savings, this accumulation of the citizens' savings in a way, it's their national bank, gets dissolved or seized. So
or canceled in the same way that Russian holdings of U.S. Treasuries were kind of canceled, right?
Yeah, that's exactly what I'm referring to, right? That's a big moment, and it's a big moment, especially for China, who could be on the other side of that. And what's interesting about this development is we've been talking about central banks buying EM bonds for 15 years now. I worked for Larry Summers in Russia a long, long time ago. He was talking about this in 1994, that central banks should own EM bonds, and it was debated whether Treasury should buy M bonus in nice and night. That was kind of an obscure little piece of history. But you know what? Central banks don't need to take orders from a famous economist, right? And luckily, in the last couple of years, the IMF has been producing a lot of reports kind of backing up this idea. And it's, I don't think the headline, dollar loses its reserve status. That's not happening, right? But headline, more and more EM countries that deserve it have become reserve assets. That's happening. So the IMF specifically noted Sing and was it Sing in Korea, Natalia? I don't think they mentioned all of it, but these are reserve assets. And the last thing I'll say is, when you see these headlines saying the United Arab Emirates agrees with India to sell oil for INR, what do you think the UAE central bank is doing with the INR? Right, they're not just sitting on it. Now, to go from a trading currency to reserve currency, a lot of steps, and it's not a headline kind of thing. But the INR is piling up, right, and it's natural for central banks to start investing that in the bonds if they did it with the U.S., right? Why wouldn't they? And that's a really important thing. DMs are globalizing and finding new financing sources, and they don't really need them. I mean, everybody needs them, and I don't think Western authorities understand. I don't think Western authorities are even set up to think that they need to do work to borrow money.
No, definitely the U.S. is not.
That you have to answer questions, that you have to engage with people, and whereas all of our country, all of the countries we invest in, think of it, they have debt management offices who have serious policies to address our question, and they value our questions, right? They want to hear what they're doing wrong so that they don't do it. So it's a very, very different. It's a trickier attitude dealing with policymakers that aren't worried about things like that.
Kind of another thing I would like to add here, kind of very quickly. It's not. I think the whole debate is often framed in terms of, oh, China is selling US dollars or somebody's selling US dollars. I think it's much simpler. Emerging markets accumulated plenty of reserves, many of them. I mean, some like Zambia, we still have to do a lot of accumulation. But the kind of advanced emerging markets, EM gratis, they simply don't need more reserves. Why? Because it's expensive to manage them. Brazil was actually talking about maybe selling some of the reserves a few years back because it's expensive. They have enough. So if you don't have that marginal buyer, who will step in? Who will be that new marginal buyer if emerging markets are not accumulating more reserves, part of which goes into US dollar denominated assets? So I think this is kind of a big. It's not kind of this huge headline, China is selling treasuries, but that's what is happening, and this is a huge process. And frankly, this process has got further to run. It's not going to end up this year or the next one. That's the future.
And Natalia, you said that emerging market countries, in general, they have plenty of reserves, so they run a trade surplus, and they use the money that they have to pile it into U.S. Treasuries or European, euro-denominated sovereign bonds or gold. But isn't it the case that if they continue to run trade surpluses, they're going to have to put that money somewhere, right? So you're saying that they're going to hold the marginal FX reserve is going to be less dollar denominated, perhaps less euro denominated, and maybe they're going to hold it in their own currency or other emerging market bonds.
Yeah, it's not the trade balance. I would say it's more kind of it's a current account, how this money are recycled effectively. But there is an argument if we have a different type of globalization, if it's more kind of regionalization rather than globalization, perhaps some of the surpluses can become smaller. And I think this is a good argument for this. And again, I mean, you sit down and you think what you buy. if you look at gold purchases by emerging market central banks after the global financial crisis, they skyrocketed. You put two lines on the same chart. One is the Polish central bank buying gold, another one is Chinese central bank buying gold. They will look pretty much the same. So emerging markets are buying gold. So there is a diversification of those surpluses that they need to recycle, with perhaps more going to gold. We're seeing these gold purchases. I said China is probably kind of a newsworthy country, but this is happening not just in China. Countries like, Brazil, Turkey, Poland, that I already mentioned. Poland added a lot to its gold reserves in the past year. So it's diversification of reserves, and also think about the size of those surpluses. It's not the type of current account surpluses we've seen in the early 2000s. They are smaller. They are back. The surpluses are back, which is great for external bonds, for the dollar-denominated bonds, but they are much smaller. So it's an issue of the size, and also the issue of how you invest them, in what particular asset you put the money, which does not necessarily have to be the US dollar assets.
And so the old narrative of de-dollarization is the US dollar is going to be dethroned as a reserve asset by the euro or perhaps the Chinese yuan. That has not really happened really at all. But you're saying there's a different transition of, instead of the dollar being 70% and the euro being a much, much smaller percentage, and the euro replacing the dollar is going to just go down marginally, but the Malaysian ringgit is going to go from 0.001% to 0.2%, and that is going to have a big impact. Doesn't sound like a lot, but it will have a big impact on.
Malaysia will not be the only country whose reserves, whose assets will be accumulated effectively by the central banks. And gold, as I said, don't forget about gold. There are other interesting assets around. I don't want necessarily to name them here, which might become reserve assets. So there is definitely, the dollar has got competition. It doesn't have to be dethroned. It's not about dethroning. It's about, the dollar assets will have to work harder to be interesting and to be attractive for EM central banks, or let's say sovereign wealth funds, for example. And this, raises a question about the yields on US dollar-denominated assets. Do they have to be low, or maybe they have to be higher to be competitive and to be attractive?
Right. So de-dollarization is happening.
Slowly and gradually.
There's not going to be a headline, all right? I don't think there's going to be a headline, but it's an ongoing process. And one thing I wanted to say is, a country can generate more dollars in than out of the country through the trade channel or through the capital account channel, right? And a lot of these countries are attractive destinations for capital. And on the question of what are they going to have as assets, they're going to have other EM bonds and their own, right? That's the ultimate goal, right? Is to have your own country's bonds as your reserve asset. It takes a lot of time to generate that, but that's what's happening. That's what's happening. You could argue that's what's happening in China.
And do you think that the result of that will be a lower value of the US dollar against other currencies, or a higher interest rate needed on the US Treasury to keep the dollar constant?
I don't know what Eric thinks. I'm more thinking about high interest rates on US dollar assets.
Yeah, I think it's kind of entering a heterodox world, basically. I don't think it necessarily leads to a negative dollar view, because most debt is in dollars, and risk off involves buying dollars, and so that is going to take a long, long time to unwind. I think the issue is that if it becomes difficult to finance, what is the natural policy reaction for a highly indebted country that has shown that it wakes up every morning trying to gin up stock markets? I keep saying that, but I think that's more or less where we are. And that's why I started with Japan as the first story. your rates go higher and your currency goes weaker. I think that's not a bad idea to have in the back of your mind. However, the U.S. is by far the least dirty shirt. Yen and euro go down before the dollar, if this is even a story, and I'm not saying that it is. And what happens is, especially when you have these big fiscal requirements, is the interest rate should go up and it's not allowed to. So I think we're looking at essentially control regimes in the West, yield curve control, for example, right? We're looking at the market doesn't want to lend you at that rate. Okay, well, change the rate, right? And if that won't lead as naturally to outward pressure on the dollar as it would in other countries because of this risk-off dynamic that most debt is in dollars, so people are buying it. I'll say two last things. If the dollar's down 20%, no one cares in America. No one's even going to know, right? But after that, it might. The other thing I'd say is, and this is consistent with this being a real process, is most people think the dollar was up. I don't know what period of time, like let's say last year, right? It's not true. If gold goes from 1900 to 2300, dollar's down, right? So we're just looking at a whole bunch of other currencies going down relative to gold. And that's, to the extent that gold is becoming much more of the reserve asset. And so I think that's something that's very, very poorly understood. Central banks, the bottom line is, if central banks are buying increasing number of bonds, you're in good shape because you have an alternative source of financing. And if the opposite's happening, that's tougher for you. Now, we're so big that if rates go up, YCC may be the answer, as it was in Japan. And that creates all sorts of other problems, which I think the conclusion of is exactly what we said. Be very wary on DM. None of this needs to happen for DM bonds to still be unattractive. Just not really getting a very high rate, and so that's also something we remind is you haven't had a crisis in really, you could argue, in the U.S. and the bonds have still performed poorly relative to DM bonds. But these are big issues, but I think they'll be managed. I think the plumbing will be managed, and that could make it a lot worse. But it attenuates it. Like all these things, they buy time, and it depends what you do with your time, right? If you're implementing structural reform, like maybe is happening in China, or it's definitely in a lot of our countries, that's great. But if you're just buying time with no policy, and that's where I think the political and policy uncertainty in the U.S. is pretty important.
So, Eric, you think there will be a time where the tremendous volume of debt, sovereign debt that developed markets have produced, will result in much lower bond prices and higher yields on those bonds? In other words, the reckoning that has appeared to be justified, that has so far not happened. You think it will happen?
I think it will happen, but I think it will be gradual, and I don't think it's going to materialize in a crisis manner. If you're not allowed to express it in higher yields, then it'll pop up in different things, and that different thing is classically inflation.
But Eric, one thing is, just wanted to draw our listeners' attention to some very interesting studies by the IMF, which suggests that the neutral rate in developed markets, including the US, is likely to increase in the coming years, which is not necessarily the case for emerging markets. So I think it's not that explosive increase in yields we are talking about, but some of the underlying drivers in developed markets might result in a higher interest rates, high neutral rate in the coming years.
And here's how it plays out very practically for your listeners, Jack, because we see this every year, and we've been doing this for decades. Government gets on TV. Inflation is 2. Your real wages went up, and you say that a few times, and then a few years later, it turns out inflation was 5 or 4. And that's, I'm not saying that that's any government, maybe they should do that, right? But that's what happens. But that is how you attenuate these things. And they become I don't think declining use of treasuries is a real thing, and increasing use of EM bonds is a real thing. on central bank assets, but I don't think it's a useful guide to practical day-to-day investment decisions. Yeah. But you can't ignore it either. You can't ignore it either because you got to know in some countries it can be a big deal.
That's a really good point that, day to day things are not going to trade based on de-dollarization, but it is happening on the margin slowly. Eric, tell us about fiscal dominance, and is it true that high interest rates can be inflationary if the stock of debt is so large? Tell us about this theory that you've had for quite some time that back in the day, a lot of developed market people did not take seriously, but now some are.
Yeah, it's still a heterodox view, but I don't think it's as heterodox as it's presented. So first, fiscal dominance is something that is part of formal economics teaching, although PhDs aren't required to take history anymore. But Natalia luckily took a lot of it. So fiscal dominance is when your debt is so high that monetary policy doesn't have traction. Doesn't mean anything. And the extreme result of this, which we've seen in a bunch of countries, is that because fiscal policy is dominating, fiscal policy is driving all asset prices, that when a central bank hikes rates, the only calculation is, debt's going to be that much harder, right? That much higher. And you're only worsening the problem by hiking rates. Now, that is basically a heterodox argument because it's not going to help doesn't mean you shouldn't do it anyway. Or just because it's not going to help doesn't mean you're not supposed to learn and do even better things, different things. Maybe use your fiscal toolkit or your structural toolkit. But the problem is when debt is too high, central banks cannot be independent. That's the main point. They cannot be independent. They can't have a singular focus on inflation because at a certain interest rate, you're bankrupting your government. That's the problem. And the EMs were in this situation in the 80s and 90s and had a whole set of different problems. And now they're largely out of it. Most of their debt's local and they have independent central banks. So fiscal dominance is a real thing. The EMs were on the bad side of it, and they now are completely on the good side of it. And you see this for their decades of surviving these DM-generated crises. And the DMs are on the bad side of it. Like I mentioned, heavily indebted governments that you could argue have co-opted their central banks to achieve economic outcomes or financial stability outcomes or government financing stability outcomes. Right? A central bank buying government bonds, that didn't, up until the 50s, that was not the tool, right? It was corporate bonds were the tool. Good central banks make speeches to their fiscal authorities and say, stop, or we're hiking rates, which again, I sort of describe the policymaking framework here as we're here to gin up markets every day and talk about some of these orthodox pillars, but really not do anything about it, right? Look at the political landscape in the U.S., right, where we're supposed to have differences between the parties. This is my description of U.S. politics and policy for the last 30 years. Republicans wanted low taxes, they got it. Democrats wanted high spending, they got it. And I'm supposed to blame one and not the other, right?
And the result is high debts and high fiscal deficits.
High debts and deficits, which are so high that the central bank is arguably losing its independence and credibility. That is a big turnoff to other central banks, right? In other words, you can go to your populations and say inflation's 2%, and then ex post a few years later turns out to be 4%. But other central banks are not going to be as easily sort of convinced by that because they live in countries where that trick's been done.
Right. And the US has an advantage of when there is a growth scare, when there is a recession scare, such as the type that we had 5 days ago on Friday, early August, that benefits US Treasury bonds because there's a bid for safety. And many countries, particularly many emerging market countries, don't have that. And when they go into recession, interest rates go up. But you're saying emerging market countries are used to that, and you actually are seeing some bid to safety-like qualities, such as in the Malaysian ringgit and other currencies. I would also say that Barry Eichengreen, a great economist who wrote a paper about living with high debt for the 2023 Jackson Hole. Of course, we got the 2024 Jackson Hole Federal Reserve symposium coming up shortly, about how advanced economies, developed markets, had very high debt loads, and that had increased. Though emerging markets have delevered over the past 20 years, and we could show those charts up. And I'm gonna take Barry Eichengreen's word for it. And so that is very central to that theme. As we approach a close, you both have been very, very generous with your time. I want to do picks and pans. So which countries you like or overweight, and which you would underweight, and why. So let's start with Natalia. What countries do you pick and which do you pan?
Okay, Germany is my pan because I think it's a great example of a growth model gone wrong and really struggling to adjust to rapidly and very radically changing circumstances. If you look at kind of what Germany's growth model benefited in the past, I don't know, couple of decades, at least three of these factors like energy, trade, and defense are no longer there. And you've got the rising populist sentiment in a country which is driven by economic, energy uncertainty and security. There are concerns about immigration policies. Overregulation is a major issue. A related problem is industrial policy, which is driven. There is this absolutely fascinating IMF study. It's not driven by competitiveness. Like only 1/3 of all industrial policy measures in advanced economies were driven by competitiveness. They were driven by other things like climate mitigation, supply chain resilience, security considerations. So, that's these issues facing German economy are massive. But it seems to me that structural reforms aiming to restore Germany's competitiveness is an afterthought at best. And this is just such a huge contrast with such emerging economies like India. I was just talking to you about this. We call India at VanEck, we call it a rising EM star, not just because, of a fantastic performance of its stock market, but because of this structural adjustment that unleashed the growth potential. And frankly, I'm not maybe less negative than many people on China for the reasons I've just described, because China knows that it's got a problem and it's trying to find a solution, which I think is a great start.
Thank you. Eric, your picks and pans.
Yeah, well, since Natalia, I think, rightly panned Germany, I'll just start with Europe, and I'll pick Poland and Hungary. For the center of gravity in Europe has moved to Poland. And the external accounts of Poland are very much benefiting from a lot of this support, and also seeing a pretty serious energy transformation. So they're the real winners, both from investment and also from, in Poland's case, from sort of remilitarization efforts. Hungary also benefits because it's not really spending that much and doesn't have to, right? That's kind of the quirk of what they're doing. So I would put those as winners, and I wanted to juxtapose it because of what Natalia said. DMEM, right? Germany's the loser, Poland, Hungary the winner, right? Double the rates, much better situations. And Natalia's economic hero comes from Poland, and so their policy is incredibly anchored. I'd also say a word for Mexico and Brazil, especially right now. We had been cautious, and we think this yen kerfuffle has created a nice opportunity. There were a few bad things that happened into this, and we didn't have significant exposure there, and it really eliminated a lot of our concerns in Brazil and Mexico local. Last thing I'd say is we continue to like duration. The big thing a few weeks ago was 5-year yields coming below 10s. I think the next, which is a big, powerful roll down argument for institutions. It's kind of like the retail argument of, well, look, your T-bill rate's 5%, but you don't know if you're going to get that in a month. And so if the next thing is that the 2-year comes below the 5-year, that's just a transformation in the attitude towards bonds. I think when people look in that box called bonds, the thing that's going to be the shiniest is going to be EM. And that, that's another view of mine. But yeah, I'd say those are, and pans, Egypt, over indebted, everybody loves it. They've gotten so much money and it looks like good news, but it is conditional money. Even the Gulf money is conditional, and we don't see any real transformations in the Egyptian economy, the ownership. And by the way, I'm not going to, I'll just use the term politics, right? I mean, that's got to be, that's an obvious additional layer of risk.
Very interesting. Well, this has been a fascinating chat. Natalia, your work is great, and you are very great about sharing it on Twitter. Your Twitter handle is Gurushina, and you are criminally underfollowed. And I think that is because, unlike me or other people on Twitter, you don't do engagement farming. You only post value. And right now I'm looking at who follows you, and it is very serious institutional investors and heavy hitters, some of whom who have been on this program. So for emerging market economics stuff, people really got to follow you. And Eric, you, of course, the Van Eck Twitter handle is VanEck_US. You don't have Twitter, but you are on LinkedIn, and the name of your fund is the Van Eck Emerging Market Fund. With I think there are three different classes: EMBAX, EMBIX, EMBYX. And Eric, just say a final thing about the emerging market bond fund. Why EM bonds over DM bonds, and then why your bond fund over passive EM index?
Why EM over DM? EM has lower debt, pays you more, and it's a winner in the current political and geopolitical environment. Why us over others is we don't wake up in the morning and salute the benchmark, and we don't do Friday meetings. If things change, we change quickly. We're very focused also. Our first step is we want cheap things. We want cheap things, and then we use some common sense, tests for non-systematic risk. That's what I'd say, Jack.
Thank you both again for coming on, and thank you everyone for watching.
Thank you.
Thank you.